morning, everybody. It's Thursday, December 7th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop those in the chat area, and we'll be happy to address those during the show. Also, if you've got any thoughts about the show, you can reach us at info@agyield.com. Real quickly here, overnight markets had March corn up 2 3/4 at 487. January soybeans were up 9 at 1304 1/2. And March Chicago wheat was down 1/4 at 633 1/4. This morning's export sales were pretty solid for corn, almost 1.3 million. Soybeans came in about 1.5 million, which was also the upper end of the estimates. Wheat was a little disappointing, kind of lower end of the estimates at 356,000, and meal was 110,000, which was in line. We got a lot to go over here this morning, so I want to shoot it over to Jason, and we got a kind of a bigger picture discussion on the CRB index and how that's affecting commodities big picture.
Yeah, thanks, Dan. Actually, you know what, Jack, pull up the CRB index. Kind of what got me looking at this last night. I was looking at the markets and watching Bloomberg News, and they kind of brought up the CRB kind of had a big down day. I hadn't looked at it in a while, so I just kind of pulled up a chart and, knowing what's going on in our markets and corn and wheat and, soybeans have kind of gotten weaker. I guess I would have thought that chart would have been quite a bit lower. So it's still pretty elevated, right? So, looking into that index, it's a makeup of ag products, a lot of different ag products, a lot of different energy products, and some metal products, but really heavily weighted in agriculture and in energy. Like 40% each, right? So 80% of that index is ag and energy, right? And so I knew crude oil was on a pretty big break too. So Jack, you can go back to that. But when you're looking at crude prices, this is a weekly chart, and you can see, we're on a $25 a barrel break since September, October. So I thought it interesting, right? Like, why isn't the CRB index down more? And I think it is, Justin made this point and kind of looking into it, right? Like some of these agricultural commodities are still flying really high, right? I mean, cattle and orange juice and sugar prices. So I think when you, put all those together, that's probably what's keeping that elevated. But recently too, if you look at those, just in a week or two, I think if you look at sugar in a week, it's dropped 15%. OJ's come off quite a bit in just a few days. Cattle, we all know, Ryland's been talking about cattle, just been, collapsing off of all-time highs in the short term, but you look at the big picture, still really elevated. So I just thought it was interesting. And I guess in my opinion, there could be room for a bigger correction in the overall CRB index to move lower. And some of the thoughts I had too, right, is when we're looking out forward, and Jack had that chart up there for a little bit, but, we've had the Federal Reserve raise interest rates. We've been trying to battle the CPI, consumer price index, inflation numbers. And I think, yeah, Jack, pull that chart back up, right? So you've had that correction quite a bit in CPI, right? So the Fed's starting to feel really good about getting inflation under control, at least short term. I think it's probably too soon for them to get aggressive, right? But if we continue to see that number stabilize or even head lower, the Fed is already talking and the market is already pricing in Fed cuts as early as March of 24, up to 6 different rate cuts in 24. And so when you look at, okay, inflation's coming down for the consumer. We've had this big rally in commodities. I'm kind of thinking about this as where's the money going to go, right? Like you had all this money pour into commodities, right, for this inflationary trade. And so there's still a lot of really, really elevated commodities, right? And you're starting to see them turn. I think a lot of that's money flow. And I'd love to hear what some of you guys think, but in my opinion, if I was an investor in some of these commodities, and I'm looking at all these changes that are coming, this changing of tide coming in 24, I guess I'd be looking at, moving my money somewhere else.
I'll say that when I look at the CRB and talk about interest rates, the question that I always pose to myself is what net effect has inflation had on the general price of raw goods? And if we look at a 3-year, we're talking about 25-30% inflation when you count it up over a few years, and we all know what that means. Grocery shopping, we've seen gas come down, but what's the new norm if we have in fact had a soft landing? Because we're not going to get rid of the additional money supply that we've put in the economy. I think it comes down to the consumer's ability to be able to participate, and it's a chicken or egg question of where do those two things meet, the consumer and the product. And when you look at overall the picture for the economy, there's some really hard numbers out there that are hard to look away from. Credit card debt near all-time highs, if not the highest. New home sales have basically stagnated, one of the worst periods of home transactions on record. And that those high interest rates have really had a strong effect on that. And whether or not we can come into the soft landing that everyone talks about, in finding out where the value of raw goods actually are, I think it becomes the commodity trade could get kind of volatile from it. With a 40% increase in money supply since 2020, does that today still make corn a 340 item in a big bear market? Well, I don't think anyone really knows the answer to that, but I certainly would not rule out that the medium is somewhere in between, that they all have to gravitate to a level where they can transact, right? That's what markets do. So I think trying to ballpark that and kind of give it some windage is the hard question right now, especially as we go into a rebalance phase over the next month.
Yeah, I'll add to that, Ben. Really a senior trader that I respect a lot is friends with my grandfather. And, so when I was learning the, trading a lot, in 2008, we had the financial collapse. He made a comment, which was, whatever the low is this year, we'll have a good understanding of what fair value is or what the low can be in these markets. And that was in 2008, 2009, when we had the financial collapse, and corn traded $3 and beans traded, I think, $8.90 or $8.70, something like that, $7.80 maybe. Anyway, I kind of feel like we're in that scenario where if we have some sort of a, to Jason's point, some kind of a liquidation phase here in general commodities, I think we'll find out what that new price point is. In my opinion, it's not $3. Right. I think there's, I think we have so much money out there, in debt, however you want to look at it. We have so much money out in debt that I think $3 corn, and I hate to be, I've always kind of made fun of people that say that the new plateau or the new level of prices, but I think $3 is kind of off the table for a long time unless there's a major problem. But, is it 4? Is it 450? I think we are generally hitting a higher price point here just because of money supply. I think there's too many things going on in the world that, $3 corn just is a tough point to get to. Land, we talked about this before we started. Land prices are, agricultural land prices are setting all-time highs still. Every day I see a new sale that's $20,000 an acre, 19. Not that those people have to make money. Those could be bad purchases in hindsight, but with 7%, 8%, 9% interest rates, and they're still hitting all-time highs. I mean, I think there's a general demand for agriculture. So I'm in the phase that, agriculture still has a underlying bid that we haven't seen in some time. I think we're probably more akin to the 70s type inflation, really volatile commodity markets than we are going into the 80s, where you have real stagnant, cheap prices, I think we're going to see a lot of volatility ahead, personally.
Well, and you know, you look at early indicators, and right, this isn't a real scientific approach to it, but we're basically having the conversation of where does the producer meet the consumer, whether it's in a raw good or finished good. And we know that input costs for next year are going to be lower for most people. In a lot of cases, a fair amount. So going back and defining what that margin looks like is really much more important than trying to throw a dart on how high the price of corn or soybeans can go, because everything is shifting, but hopefully they're shifting in tandem to allow opportunity to be able to lock in your business needs. And, you know, I think that when you look at some of those early indicators, we mentioned a couple of weeks ago that steak had come down, right? And that was why cattle was making all-time highs. But that's the market adjusting, saying, hey, we've got to move product, whether it was seasonal or not. It was the first time in over 2 years that we saw, and I'm going to use the general Costco reference, we saw an immediate $2 adjustment in the price of strip steaks. So I think that's where markets are trying to find what is that new balance, and generally that should lead to some sort of volatility.
You know what's interesting to that, and Dustin, I'm going to shoot it over to you, is, you know, you just had a big, you know, one of your big, you know, peer group meetings yesterday, I believe it was, or maybe 2 days ago, talking about, you know, cost of production. And, you know, when we started looking at the numbers of our clients, it really hasn't come down much. You know, like it's a big talking point, but, you know, the fact that fertilizer, some of these inputs have come down has greatly been, you know, offset by interest rates.
Yeah, I think the biggest one that is interest rates is, you know, even though nitrogen prices have come down, but we've seen, you know, lands steady to even a lot of increases again. You know, landlords that might have felt that they were under market value and they've been kind of slowly raising it on them. But
you're talking rents, Dustin?
Rents, yeah, mainly rents, yeah. So yeah, I think the land costs are certainly not coming down. And so on average, if we saw like, you know, and I think this is a lot of the university data as well, we were seeing growers in the 560, 550 break-even range per bushel on an APH for corn last year. They might be in the 520 to 530 range this year, even with major drops in nitrogen cost. So why is that? It's higher interest, higher land in some cases. We're going to need to see a really good yield to make that number work. And, you know, today we're below that level on the board. So,
which, you know, Dustin, it reminds me of, like, you know, 2010 to 2000, I'll call it 2015, 16, where we had a similar situation at lower prices, you know. So, you know, going back to Econ 101, you know, are we having cost price inflation? You know, where it's the cost of, you know, growing items, you know, things like that, you know, keep inflation higher than we think on the ag side. It doesn't mean it's necessarily a rosy picture. You know, $5 corn, you know, if you're losing money at $5 or $6 or $4, it doesn't really matter, right? It's how much it costs you to make it. You could argue that your profit, you know, your margin goes down when you're at $5 corn and you need to have record yields to break even. That's a pretty scary scenario.
It is, and we're going into, you know, a large carry into the next year. So we might be able to use some of this year's supply for next year's demand, which is the biggest concern for equity loss, right? Because growers are not, you know, they're cash rich in a lot of cases right now. They've come off of a couple of good years of equity building. So, you know, they're still willing to pay those higher rents. That's why they're high, right? There's still competition for the ground. That is a setup, though, like a 2014 or 2015, where we did see a lot of equity destruction those years, just because we came out of a bull market situation with high expenses and high supply, right? And it just took a while for some of those things to start coming back down again. And maybe they don't need to come back down. Maybe like you said, with money supply, all the expansion of money supply that we've had in the last couple of years keeps prices, you know, in this range of continuing to try to incentivize growers to, make a return. I do just think the stakes are a bit higher this year, though, where equity loss is probably a bigger risk now than it was even last year with high cost.
Yeah, if you look at, if you go back to charts and look at the transition from the 50s and 60s into the 70s, the amount of volatility we had, right? There was huge, profitable years, huge, bust years. I think we're in that kind of situation, with what's going on globally. We've had such a huge expansion globally in production, and now we've got this inflation out of nowhere. It feels like, at least, in the last 18 months, and you've got, geopolitical issues. Like, I think we could be in a super volatile time frame where you have really profitable years and really unprofitable years. And, it could be just at higher price points, in my opinion. Just it's, the time of cheap interest rates and really cheap inputs, it could take a while to get to that point if we ever get to that again.
That's really good. Great discussion here today, guys. When I don't have to say much, it's a really good show. Also, I wanted to announce while we were visiting here this morning, USDA announced the sale of 121,000 beans to unknown for 23. So we'll put that in the books. Any parting shots here, guys, before we call the open?
Yeah, I would say one thing. We're opening right now. I'll let you give the numbers, but we are down sharply in wheat and up sharply in beans again. So that inverse relationship wheat beans still seems to be something to watch.
That's good stuff. Yeah, like Dustin said, March corn up a penny and a quarter, 4.85 3/4. Jan beans up 7 3/4, 13.03 1/4, and March Chicago wheat down 7.5 here at 6.26.
Yeah, it'll be telling to that real quick is how we close today. To Dustin's point, if we close wheat higher and beans lower, for example, it'll show that we're still liquidating that position. So it'll be interesting. Yeah,
and saw Dan just had a comment come through. Equipment and repairs, have done nothing but go up as well. So, and just another factor in these costs and what guys are facing as we're looking out to this year and out forward to 24.
Yeah, labor costs a lot of that, I'm sure too, right? It's been a big sticky issue for most businesses.
Definitely.
Really quick, Dan, I wanted to get to the meats too. Just today is a big day for a seasonal up in the cattle market. Big sell-off yesterday, and kind of going to that wholesale versus retail kind of mentality that we've been talking about, where those prices kind of meet. Today's crucial. We need to see some follow through up just for a little bit more of a near-term support kind of level, just because we got these big discounts here in the live cattle market. But, going to that point, we are at a level where, we've never seen before, and we just started breaking, and we're just cracking back down towards the highest level of, previously. And just coming out of the pandemic lows, which were in the 90s. I mean, just to add to that point, we could go back to that $1 to $1.30, level for cattle. It may take some time. The market's going to adjust, and I think just retail versus wholesale, that relationship is going to be really important for how this thing moves for the next 6 months to a year.
Very good. Appreciate that, Ray.
Thanks, Dan.
Couple of housekeeping items here. Tomorrow, we will have a special live report at 11:05 Central Time after the USDA report numbers have been released. You'll get our comments and thoughts on that release. So that will be a new delivery that we'll have tomorrow, in addition to our regularly scheduled show at 8:15 Central Time. So as always, streaming live on YouTube, Facebook Live, and X, 8:15 Central Time. We appreciate everybody's participation today, and also for you guys, checking in and viewing and taking a look at us. And we look forward to seeing everybody twice tomorrow. So have a great day.
Thanks, Dan.
Thanks, Dan.
Thanks, guys.